Are VA loans assumable? If you're looking to buy in Broadwater County, Lewis and Clark County, Jefferson County, Silver Bow County, and Gallatin County, Warren County, we have you covered. Jeannie Steele here with Steele Realty. In this video, we're going to talk about VA loans and give you the pros and cons of assuming a veteran's loan. Are you asking yourself, are VA loans assumable? Well, the short answer is yes. Even if the buyer doesn't have the usual military service qualifications, they may be able to tap into the cost savings of a VA loan because VA loans are assumable. Let's check out how this could impact you and your home buying process. Assuming a VA loan is a lending process where the buyer takes over or assumes the veteran's current home loan. First, let's talk about what the VA loan actually is. The VA home loan program actually insures and guarantees your loan if you are an eligible veteran. But the money comes from a private mortgage lender who must also approve the loan and who is probably your mortgage company. They also must approve the assumption of the existing loan based on the credit history and DTI ratio of the buyer. Second, what is an assumption? The VA loan assumption transfers the existing loan balance, the monthly mortgage rate, and the interest rate. When assuming a VA loan, the buyer must agree to all the terms and conditions that exist on the current loan. The VA loan assumption and a traditional home purchase are different in some fundamental ways. Not all VA lenders will allow you to assume the loan. Third, how do you assume the loan? You need to work directly with the servicer of the current loan. You cannot choose your own lender. One of the advantages of assuming a VA loan is that you can assume it at the current locked-in interest rate. With the increasing interest rates, this could be a great advantage to a buyer with the current market conditions in 2023. A buyer who is going to assume a VA loan will need to be able to prove that they can handle the mortgage by demonstrating a credit score of 620 or better, a debt-to-income ratio below 41%, and enough of residual income for yourself and your family. A buyer must also agree that the house will be your primary residence. The private lender may need other documentation, including a proof of employment. To assume a VA loan, the new home buyers must meet the lender income and credit requirements. The home buyer must pay the funding fee, which is 0.5% of the remaining loan balance, unless that's exempt. The buyer must assume all the mortgage obligations. Depending if you are the home buyer or the home seller, there are reasons both for and against assuming a VA loan. Buyers need to thoroughly consider all loan options because assuming a VA loan may not work in your favor. You really need to consult a loan specialist with VA loan experience. Pros for assuming. If the VA loan is assumable, it negates applying for a new loan. The buyer can avoid closing costs and appraisal fees, likely saving thousands of dollars. A first-time VA loan user pays an average of 2.15% of the VA funding fee. A second-time VA loan user pays even more, but the VA only charges 0.5% funding fee on the loan amount for the assumption, which is far less than the other fees. If the original VA loan was approved at a very low interest rate, there's a good chance the new loan would have a higher interest rate. For example, if the loan was established at a fixed rate of 3.1%, let's say in 2020, and then in 2023, the best VA loan interest rate comes in at 6.2%, it's easy to see the savings add up for the buyer. Cons for assuming a VA loan. The buyer must certify the loan assumption is for a primary residence only if they want to swap the housing entitlements with the seller. If a civilian buyer assumes the VA loan, the remaining proportion of the seller's VA entitlement in use stays with the original loan. The veteran cannot retrieve the remaining eligibility until the loan is paid off. This makes a short sale or a foreclosure for the civilian owners difficult. This is something to consider because the veteran owner loses the proportion of their benefit. Something to note that lenders are not required to issue VA loan assumptions. Some lenders do not have automatic authority to assume VA loans. They must send the requirements all to be reviewed by a VA loan officer, and everyone involved with the home sale is subject to waiting for the VA. We have no control over when they will respond. Sometimes it can happen quickly, and sometimes it can take some months. Veteran buyers who want to assume a loan could be on the hook for exceptionally a large down payment if the current veteran owner sells their home for more money than they owe on the loan. The seller wants more money, the buyer would have to come up with the difference for a down payment. So take a look at this. If the sale price of the home is $499,000, the VA mortgage balance is $399,000, the down payment needed would be $100,000. When the purchase is complete, it's very important for the VA seller to obtain the documentation that talks about the release of liability form. This way they take their eligibility with them and make sure that it was released from the home. Before a buyer assumes a VA loan, they need to compare the terms and conditions with the current rates. In some environments, it's better to obtain a new loan rather than assuming an older loan. But with interest rates on the rise, it's a very viable option. If you have any questions, you can call, text, or email Jeannie Steele with Steele Realty, your real estate professional.